Has the stock market bottomed? How do you know when it's bottomed? How do you know when it's over? We're talking about it all right here, right now on the Money Markets and Mindset podcast. I'm in a different setting today. I'm actually in Atlanta, Georgia, hanging out with my best friend for his birthday weekend and the holiday weekend. I got my notes right here on the notepad on some topics that I want to cover, but I really want to just break down the thought process behind, how do you know if a market's bottom? How do you know if a stock has bottom? And then how do you wrap your head around coming to grips with the fact that you need to make a decision to either buy or not buy? And you got all this news swirling around about inflation, about the war that's going on, high gasoline prices. So how do you take all that information and make a decision if it's time to buy some stocks or it's time to start investing or not? Well, here's the thing that you got to think about with respect to calling the bottom. No one ever really knows where the bottom is, when the bottom's going to come in, and the exact moment and date and time to say, this is it, this was the last day, this is the day I should get in and purchase something. However, there are indicators and things that you can pay attention to that starts to give you a sense or a feeling that a bottom may be near. And the bottom is not like a one-time event. It is a process. So it's, the stock may, or the market overall may be falling, then it may bounce a little bit, fall again, maybe go slightly lower, bounce a bit, start going sideways. And it's not until you kind of look back and you say, that was it right there. That was the bottom. And so what are the things you can do to get proficient at identifying when a bottom may be starting to form? I don't like to say when a bottom is happening because that makes it sound like a one-time event. But when a bottom is starting to form, is go back in history and look at other times where the market or a specific stock has sold off really big or what feels like really big based on bad news. And then kind of ask yourself, what did that process look like as it started to round out and be done selling off and be done losing value? What did that process look like? Did it happen over a couple of weeks, a couple of years, a couple of months? And then what did it look like? Did volume start to decline? Did the candlesticks start getting smaller and smaller and smaller as it sold off? And if you don't know what candlesticks are, well, then obviously you need to kind of study and consider learning this information, right? Which is stuff that we teach inside of our course. In fact, inside Power Trades University, we were talking to our members about 2 weeks ago. And I told the members, I said, I believe it's time to buy. I think the market is oversold, but I'm gonna back that up with why I thought that. Because going into the market with just emotions and saying I think it's oversold, I think it's time to buy, doesn't really hold any merit. Like if you were some type of financial investor managing people's money and they said, "What should we do?" And you said, "I think we should buy," and they said, "Why?" And you said, "Just I don't know. I just got a feeling." That doesn't really jive well. So let me talk about why I was telling members that I believe it's time for us to start putting capital to work. I was looking at the indicators, okay? And so indicators are not 100% fail proof. So some people say, well, why look at all these indicators and things on the charts? Because the name is implied of what it's supposed to do, which is indicate, not 100% predict. It's not called the 100% predicticate. It's called an indicator. And an indicator tries to indicate what's going to happen next. And so there's a time to use an indicator like stochastics, which is one that we teach in our master's class. There's a time to use an indicator like MACD, moving average convergence divergence, which again, we teach in our master's class. There's a time to use the histogram. So there's a time to use all of these indicators. And when I looked at some of the indicators, I was like, guys, I'm not trying to call the stock market bottom because that's not what we do here. And that's also too much pressure to be like, was I right? Was I wrong? But I said, listen, I'm looking at these indicators. And when they hit this certain level, history has shown that the stocks and the market is oversold. We also looked at the VIX, which is the Volatility Index. I'm like, guys, the maximum amount of fear has been hit. Fear hasn't jumped higher than this since the '08 crash. And we're not staring at an '08 real estate crash or anything like that. And so we've kind of hit our maximum amount of fear, which means the market is forward looking. And if the market is forward looking, it means that while you're worried about inflation today and you're worried about high gas prices, the market's forward looking. So the sell off happened because we thought today would come. We thought inflation would come. We thought the high interest rate would come, and it came. So now that it came and it's here, the market has already priced that in. So as the news and different things are still talking about inflation, high gas prices, that was already baked in when the first sell-off happened. And so the market's forward looking. So that stuff's baked in. And then I'm looking at the indicators. I'm saying, look, these are showing that these specific stocks and the market may be oversold, and the fear has already hit its all-time high. The only way the fear can go higher and the market go lower is if we get some new information, which we have not gotten. We haven't gotten any new information. The war's still going on. Depending on when you listen to this, the war still happening between Russia and Ukraine. The gas prices are quote unquote high. Interest rates are increasing. The Fed's, tapering and raising interest rates and starting to remove monetary policy. Not remove fiscal stimulus is what I meant to say. And so the market has already baked that in, which is why we sold off. And so these indicators that we were going over with our members, I'm like, hey, based on this, it might be time to start buying or at least start dabbling. I'm not saying put your whole account into something because we never know when the absolute bottom is, but we need to start to dabble. We need to start to be in the market and have a position and be involved so that you don't miss out on the quote unquote rally. And sure enough, the last week or so, market kind of took off, right? Now, it's still well below where it fell from, but we had a pretty decent rally. And I can tell you for myself, just some of the stocks I'm in, I mean, if I didn't make that decision to get back in, it would have cost me $30,000 because in 1 week, the positions that I decided to start to take have already increased by $30,000. And so that brings me to my next point, which is understanding risk reward ratio. All right. So first, when calling the bottom, you have to understand, let's just recap what we learned. So what we're talking about so far. First of all, calling the bottom is very hard, but it's important to recognize when a bottom may be forming, okay, in the market. And then also understand that the market is forward thinking and some of that information and news is already baked in. It's like you can't just keep waking up every day saying, but inflation. Like we already know that. And we're already doing stuff to combat that. So that was my first signal that it may be time to buy. My second signal that it may be time to buy was that we're looking at the indicators that are saying things are oversold. The maximum amount of fear has been hit. And these indicators have not, when they reach their max, like low level, I haven't seen them break down below their max low level. They would have like nowhere to go. So it's almost like telling you like, yep, this is roughly an indicator that it's the maximum amount of selling that this stock is now oversold. So understanding how to predict or have an educated guess of when a stock is oversold, when the market is oversold, is huge. And that's where these indicators come in at. Then the third thing is understanding risk reward ratios. And so when you look, I'll take a look at Amazon for an example. So Amazon was trading near 4,000. It was trading about 37.90, so almost 3,800, 200 points shy of 4,000. Amazon has sold off all the way down to about $2,000. I'm looking at this, I'm saying, okay, it lost 50% of its value, which you could probably say 50% of that pop was attributed to the pandemic. So a lot of the stocks that surged during the pandemic are starting to come back down, come back in now that the pandemic's kind of over and now we're trying to fight inflation. So it made sense that some of these stocks were sold off. But a stock like Amazon selling off over 50%, this is where you start to think about the risk reward ratio. Because if you're like, well, I'm gonna wait and see how much further it can fall, you start to say, well, a good company like Amazon isn't just gonna continue, it's not gonna lose another 50%. And all of a sudden, if you take the first 50% it lost and then you take another 50%, you think it's just gonna lose 75% of its value? Like, probably not. And let me tell you why probably not. We'll talk about that in a second, right? Because we got to talk about the fact that we have to understand business and what companies do. So I'll touch on that in a second. But it's most likely not going to lose 75% of its value for no real reason, unless some new information gets introduced, right? So here's what I did with the students. I said, if you look at something like Amazon, it's back down near its pre-pandemic level. If you look at where Amazon was trading at before the pandemic, it was trading around the $2,000 level. And so what that told me is if you take the pandemic out, we're back to the normal business. And did you like the normal business? Did you like the normal stock pattern that Amazon was in? Yes. Well, it shot up. It doubled in value during the pandemic, went from 2,000 to almost 4,000. Well, now it's back down to 2,000. So to me, common sense, if we take the pandemic surge out, we got to take the pandemic price appreciation out, which brings us back down to $2,000, which is roughly the value of the ordinary business. Now, if the ordinary business can capitalize on all the people who started to shop during the pandemic, all the new customers who said, I'll never buy anything online, who now are willing to shop online. They also raised their Amazon Prime prices, which is also going to be money that's coming into the company. You also have the fact that they still are working on perfecting grocery delivery, which can now start to take revenue from, grocery stores. So there's still room for the stock to run. And so you have to think about the risk reward ratio. When it gets down to about $2,000, the risk is not that, well, what if it falls down to $1,000? Again, I don't see the valuation getting cut in half again. So to me, the risk isn't, what if it falls to 1,000? It's like, you probably saw the maximum amount of sell-off in Amazon that you're going to see. Now the risk compared to the reward, maybe it'll fluctuate up 100, down $100. But now to me, the risk is that you miss out on the reward, which is what if it can get back to its pandemic highs, which is what if it can get back to $4,000? So to me, I'd rather be in around 2,000, knowing that it could fluctuate up or down 100 or 200 points, with the potential to make 2,000 points versus on the sideline saying, how much lower can it fall? I don't know, 100 points, 200 points, but how much higher can it rise? 2,000 points. And so when you understand the risk reward ratio, it's less about has the market bottom or has a specific stock bottom, and it's more about at what price are you willing to pay to get into the game for the stock? At what risk reward ratio are you willing to put capital to work to say, like, I want to be involved at these numbers so I could potentially be a part of that reward? Because again, I bought some Tesla stock as well. Again, the combination of the things I bought, the risk of where it could fall didn't outweigh the reward of where the stock could go. And again, that reward for 1 week has been to the tune of $30,000. Now, full disclosure, I didn't close out the positions yet. So, technically you can't count the $30,000 until you actually sell and pull the money out. But I'm just saying the appreciation in my brokerage account, just from those few trades I made, are up $30,000. So that was the risk. The risk was maybe it falls a little bit and I lose 5 or I'm down 5 or 10,000, but that's okay because I'm willing to hold it. But I didn't want to miss out on that upside based on how far these stocks in the market have come in. And so you have to understand risk and reward ratios, be able to understand what's your risk tolerance, and then what are you willing to risk to get X amount of reward? Like how much money are you willing to put to work in order to make that much? And is this the best time to actually do that? Because the market, if you would have said, I'm willing to risk this to make that on Amazon at 4,000, I would have said, but this isn't the time to do that. It's at all-time highs. In fact, we risk coming down off the pandemic highs because we can't sustain that amount of spending forever, because we're taking stimulus out. People have to go back to work. Student loans aren't being deferred anymore. So we can't keep running that high and that hot for that long. So doesn't matter how much you were willing to risk for what you were willing to make. That wasn't the time to do it. But that's where reading stock charts come in at. And so now that the market and certain stocks have sold off, you can say, I'm willing to risk this amount of money to make this much. But we also have a chart and a price level that lines up with that risk reward as well. Does that make sense? So you have what you're willing to risk financially and what you want to make. But then we also have the stock sitting at a level that matches that you shouldn't lose more than this. And you should be able to make at least that, if not more, if the rally resumes and continues. So when the stock chart risk reward ratio matches up with the risk reward ratio that you set for yourself as a trader, that is when it's beautiful and it's time to put capital to work. All right. So last but not least, you have to understand business. And so if you don't understand, understand how to interpret the news, reading indicators, understanding your risk reward ratio, I'm going to tell you right now, you need to be with us inside Power Trades University. That's what we teach, from the courses to the live trainings. And if you're already a member, because I know members listen to the podcast and watch the YouTube channel as well, don't take for granted the information that you have. So many times we'll talk about something and someone will say, I didn't understand that. And I'm like, it's in the course. It's module 16. They're like, I didn't even watch module 16. And you're like, why not? Why not? You got access to the information. And so if you don't have access to the information, you need to get the information. If you got access to the information, you actually have to take the next step and do the work, they're video modules. Watch the teachings, ask questions if you don't understand, participate in your own rescue. So now when we talk about understanding the business, we have to understand that these companies still do good business. So Amazon still does good business. Just because there's inflation, just because there's high gas prices, doesn't mean they just closed all their warehouses, sent all their employees home and said, we're not going to sell anything, right? Companies don't just do that. Companies say, okay, how can we manage to this inflation? How can we manage the labor cost, the raw materials cost, the supply chain? How can we manage this? And so what companies do is they don't just sit there on their hands and say, I guess we're going to go out of business. I guess our valuation is going to get cut in half. No. Businesses have levers that they can pull, just like the federal government has levers that they can pull to keep the economy afloat. The federal government can throw stimulus at the economy. They can raise interest rates, lower interest rates. There's a whole host of things that the federal government can do to make sure that the U.S. economy doesn't explode or implode. Okay. And so knowing that every time it looks like we're going to implode and go under, the government comes to our rescue. Think about it. When the banks were about to collapse, the government came to the rescue. When people were losing their homes, the government came to the rescue. When the pandemic hit, the government came to the rescue. The government will always come to the rescue because the government is not going to let the great economy collapse. We're not going to just wake up and be a third world country. They're not going to let that happen. So you have that insurance option that the government will always come to the rescue. But then you have to think about the levers that businesses can pull. Okay, so what can businesses do to combat inflation, to increase profitability, and to stay afloat? Number one, they can lay people off. All right, so just that quick, they can just cut their labor staff and save a ton of money just by laying people off. That's one thing that businesses can do. Second thing that a business can do is they can slow down on their marketing spend. And so they don't have to run Facebook ads or run TV commercials or however they advertise. So that is a lever that they can pull and say, like, let's save that money. We can lay people off. We can stop spending money on marketing and advertising. Those are two levers that they can just pull easily that doesn't affect their customers per se. It's just internal. You won't even know that they did it if they laid people off. You won't even know that they stopped spending money on television commercials, radio ads. They can just pull those two levers and immediately generate cash, or at least stop bleeding cash. The third thing that they can do, and we'll just leave it at these top three. There's other things they can do, but the third thing they can do is they can raise prices. A company like Amazon could raise its prices by $1. They can raise their price by $1 and generate millions of dollars. They can raise the prices of of how much they charge people to sell on their platform. They could do a bunch of different things to raise capital as well as slow down the amount of money that they're spending. And so businesses have levers that they can pull, which is why when the stock sells off to a certain point and it's oversold, people understand that the company has options and things that they can pull to stay at that level. And if the market starts to improve, we should be along for the ride for the appreciation. And that's where you can start to look at the chart and say, that's why it's oversold. Because they still have a core business that is thriving. And then they still have levers that they can pull to make sure the core business survives. And if the economy, not if, when the economy gets better, because we've never stayed in a recession. We made it out of the 9/11 with planes flying into the building in New York. We've made it out of the pandemic. We've made it out of the '08 real estate crash and bank and financial crisis. Every time, if you look at the history, we come back roaring stronger, bigger, and better. And so it's not a question of if we'll come out of this. It's when we come out of this, you want to own some of these stocks at a great price when they sold off and be part of the great appreciation as they start to run back up. So can you call a stock market bottom? It's very hard to do. It's damn near impossible to pick the exact time that the bottom is going to happen. But can you recognize the process of a market or a stock beginning to bottom out? I 100% believe you can. I believe it shows up in the chart. I believe the indicators will indicate to you when that is happening and when it may be a safe time to start to consider. I think if you understand your risk and reward ratio and you mirror that with reading the chart, then understand, can this chart even produce the risk reward ratio match with the type of money that you have and the money you're trying to make, as well as when you understand business, the core business of the company you're looking at, as well as just business in general, understand the levers that they can pull, you'll feel that much more comfortable putting capital to work. And if you don't know how to do any of those things, or you think you do, but you're not doing them well because it's not reflecting in your bank account, you need to consider joining us inside Power Trades University. You need to be inside someone's program who can explain this to you in a way that A, you understand, B, you can ask questions, and C, you need to start to implement so that you can get the results that you're looking for. So is the bottom in? I don't know. But what I do know is I'm in a position where I like the stocks I own and I like the appreciation I'm seeing in my account. And I hope you do too. And if you don't, let's change that. I hope by listening to this episode or watching it, you have the wheels turning on how you can make better decisions when the stock market could be potentially bottoming. I'll see you in the next episode.